Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello, and welcome to another episode of Dividend Discussion here on Dividend Obsession. I'm Troy, and today I have the pleasure of speaking with Amber McCollum. Amber, go ahead and tell the people a little bit about yourself.
Hi, everyone. I'm Amber McCollum. I am just a normal, regular person that loves investing.
Yeah, I mean, that's the best introduction of all time right there. Okay, so Amber, if you wouldn't mind telling me, how you, speaking of investing, how you got into investing in general, like when that started, and then how, like, kind of how that journey has molded, and then what got you into the dividend side of investing in particular.
Sure. So, I mean, going way back, I was just taught to be a saver, right? Save my way into wealth, I guess, which I think is really tough. I advocate for saving, but as I got older, it's like, man, this isn't going anywhere. I'm looking at my savings account. There may be something in life where I have to take out of it, and then you start again, and you're getting just very small returns, if any, in a savings account. And so I was like, I have to do something bigger and better. And for me, it really got easy when technology allowed you to invest, like apps like Robinhood, things like that. And I know there's a lot of controversy about that,
Yeah.
but when you can do it easily and you don't have to call, Edward Jones or whoever to actively manage your portfolio, then it's kind of like it gives you a little bit of a dopamine to be like, man, I'm doing something, I'm growing something. So my very beginning into investing was just regular stocks, just on Robinhood, and a few different apps. And I think it's Acorns. I don't even know if it's still around.
Yeah.
I started that, and it would take the change and just invest it. And I kind of forgot about it, opened it up one day and had a lot of money in there. Not a lot, but a lot for me.
Mm-hmm.
And I was like, okay, this is better. And I think that was the beginning. And then I just really, went down the YouTube trail of learning more and, figuring out plays, and got really interested and invested in doing it.
So, I mean, you brought up a lot of good points there. One, like the lower barrier to entry is really important because, like, way back when you used to have like a large sum of money to even start investing, and there was all kinds of fees, and like you said, you had to call so and so up to do whatever transaction, and then Robinhood and others came along and allowed you to do that on your own, which is good and bad because now, instead of you calling somebody and either letting them know you wanted to buy something or asking them, hey, should I buy something? And while nobody knows where the stock market's going to go, but somebody probably has a little bit more education than the average Joe, which may be helpful versus, you just open in Robinhood, you can buy whatever you want, whenever you want, or kind of. So, I mean, that's kind of cool. You mentioned that, like, starting from nothing, like you didn't have the knowledge, you didn't have a lot of money and stuff like that. So I can actually really relate to your saving thing because that was my goal. Is I always had a certain amount of my checking account, and then my savings account was just to build it as big as I could. But you're really like, you're doing all the hard work there. Like it's just you. I mean, and you're, measly 0.1% interest that you're going to get from a savings account or what. And if you want to feel cool about yourself, you'll get a money market account and get even like a little bit more, but it's still nothing. So I was definitely on that path too, because I remember every year for my birthday, which is October 28th, and then for New Year's, I would always take a screenshot of my checking and savings account just to like check my progress. And then I got into investing, and it's funny because I took a screenshot like that year too, and it looked like I was broke because I had no money in my checking or savings because I actually moved all that over to my investing account. So, but yeah, I like that. So like do you remember like the year roughly that you got started?
Probably 2016, maybe. Yeah, before then I did use outside. Like I had a Roth and I had other places. So it was I've been investing before 2016, but probably like using the apps and
Mhm.
really doing my own thing. Maybe that's about right, I
And
think.
did you, whether it was before 2016 when you were doing it like through, workplace or Roth IRA or something like that? Were you doing dividends back then? Did you know about dividends, or did you get into dividends when you started doing it on your own?
I got into dividends when I started doing it on my own. In fact, I was so nervous about what they were doing that I was like, I just want 50% risky and 50% safe. So looking back, it was the awful decision because I could have made so much money even with them managing it if I would have done it differently. They put it basically in bonds or whatever for a while. I was making nothing, but it felt safe. I would look at it, okay, I haven't lost anything. I think I had just a scarcity mindset of
Yeah.
I'm trusting you with this and I don't know what you're doing and I certainly don't know, so I don't want to lose it. Just don't lose it. Whatever it is, it's really hard. I matched my company as much as I could and I was able to put in a little extra than um, what the matching required.
Hmm.
And so I was definitely putting all of it in, but the returns were terrible just because, you know, I didn't believe it really. So I think that's a big part of it.
I wonder, because you sound the exact same as. So let me know if I'm reading this right. Because you were a saver, and like I just said, I was the same way. I was almost more afraid to lose money than I was excited to make money, if that makes sense. That sounds like the same way you, especially with the 50-50 split, you were just like, okay, like it's cool, the idea of me making money, but I really just don't want to lose it. Like, how can I not do
Right.
that? So I
Right.
wonder if that's just like the mindset of like a saver first, is you just want to, even if I'm only making $10 a year off of interest, but I could be making 100. If that 100 gives me the opportunity to also lose 100, give me the 10. Like I'd rather just have the 10. I don't want to lose 100.
That's
Which,
right.
it's obviously your timeline plays a lot into that. I don't like saying age, because like you could be starting your investing journey at 55 and then you have 20 more years and you're going to go till 75, or you could be starting at 18 and have 20 years and go to 30. Like well, obviously that's not 20, but like you can go to 38 and that's completely different. And like the end goal is the same of 20 years, but like the age at which your 20 years invested is completely different. So, I think it's more related to your timeline than your age. But yeah, so that's really interesting. Do you remember your first dividend stock by chance?
My first dividend stock was I think PepsiCo, probably.
It's
I think
typically like
I
one of
saw
those kings aristocrats. Like a lot of people do like
yeah.
Johnson and Johnson, 3M, Coke, Pepsi, Procter and
Yeah,
Gamble.
I saw it and I was like, okay, this is gonna go places.
Yeah, people drink Pepsi,
But
right? Like, yeah,
exactly. Oh, but I mean, they own everything.
yeah.
And when you really get into that and see the moves that they've made, even it's forget about if people drink Pepsi. Pepsi's not even the biggest part of what they
Hmm.
have. I mean, if you put Pepsi and Coke against each other, I think Coke outweighs the sales, even though on the blind test, like Pepsi will do better. But like Pepsi Co. strategically built out
Hmm.
acquired. I mean, their acquisition business was like boom, boom, boom. We're acquiring so many things to where it's attractive no matter what. It's attractive even if it doesn't provide dividends. Like it's an attractive place to hold money just
Yeah.
because it's a company that I feel like can't lose. Hate to say that. Because that's anything can happen, anything can lose. But I feel like it's just one of those that it's hard to fail.
Yeah, I mean, it's not even necessarily that their moat is big. I mean, their brand recognition is obviously worldwide, but like it's that umbrella that you're talking about where like whether some people, especially like people that aren't into the stock market, like the CEO of Pepsi might do something dumb. They're like, I'm not going to buy any more Pepsi, but then they go buy, Doritos. And then they're like, they don't even realize that they're still supporting the same company. I think Doritos and Lay's and those guys are under
Yeah.
there. So,
Yep.
where
Yep.
like that's why I've always like I personally prefer Pepsi over Coke. Now, if I go out to, I don't get sodas when I go to restaurants just because the ungodly amount of money they can charge you for a soda, which is I think ridiculous. But if I were to go out to a restaurant and order something, I always ask for Pepsi. But they say if we only have Coke products, I get the Coke too. It doesn't matter. But it's one of those things where I also prefer Pepsi stock over Coke for that exact reason. I just feel like they have so much more than just like what happens if there's like a sugar tax or something that they're going to implement and it like really hampers like the soft drink industry. Well, Pepsi has a bunch of other avenues that they can still make money. Well, you could argue that, you know, chips and other things like that could also have, you know, an unhealthy food tax or whatever. But, you know, Coke started branching out a little bit. Like they have different waters and stuff under them as well. But, I mean, a majority of Coke's money comes from Coca-Cola, Coke Zero, whatever. So, okay, so that's interesting that Pepsi was your first one because I briefly owned Pepsi, and this was just like my learning process going through the whole thing. I sold them just because, you know, I didn't know what I was doing kind of thing. But I owned Pepsi at one point. I'm pretty sure I owned Coca-Cola at one point. Okay, next question. So what is your biggest dividend-related mistake? And more importantly than the mistake is what lesson did you learn from that mistake?
Yep. So I think chasing what's popular. Mm-hmm. And I can't point that to one mistake. I think you can get caught up in the psychology of it and just be like, oh, this, you know, that's on its way up. And so I know it's going places and it's offering, you know, huge returns. So yes, I'm going to jump into that. And then it's like, you are the market, right? Mm-hmm. That's the biggest lesson to learn, really, that you have to not be the market. Actually, mm-hmm. You have to do the opposite of what everybody else is doing. And I feel like just to your point, like with your own managing of things, it's like, oh, this is hot. I'm reading all of these articles. Mm-hmm. In fact, I don't do that anymore. So I may watch YouTube. I may watch personal stories. I'm in lots of groups where real people are doing real things, but the articles, I don't really trust them anymore. Mm-hmm. I just feel like, if anything, I would rather just hold a position forever if I believe in it and watch it grow than read and learn about things that are like market trends, because I feel like I don't have the time that I used to have. And so that's not something I don't want to be the market.
Yeah. Well, I mean, I've thought about this before. If everybody identifies good companies and you never worry about, you know, trimming positions or selling a position or anything like that, in theory, the market would never go down. Like it's the emotion and like people putting the emotion in the market that causes it to fluctuate as much as it does. Because like look at COVID, for example, like it was the fear of this virus, you know, the epidemic, the pandemic, like all kinds of stuff like that. And it quickly dropped the market. But then it just went right back up and then some of where it was. And it was like the quickest turnaround like ever. And it was just one of those things where it's like, wow, like the emotion, the fear drove this market drop. But then like the excitement, or like that many people did not become educated about stocks that quickly. Like there's no way, like I started during that period too. But I like, I was talking in another interview and I was just like, I started during like, it was like April or May of 2020. And, you know, Dave at that point, he was like, oh, like you got really good timing. I'm like, well, that's implying I knew what I was doing when I started, which I definitely didn't. So, I mean, I've walked backwards into a couple good picks. Like I still have AbbVie and I still have ExxonMobil from a long time ago. But like most of my stuff was just like buy and sell. I didn't know what I was buying. Like my first stock on Robinhood, I just bought because it was the biggest winner from the previous day. I'm like, surely if it won, you know, 37% yesterday, it's going to go up again today. So, not a good strategy there, but, yeah, I do like that. Don't be the market. Like the emotions in it. Like if you can take the emotions out of it yourself and then just buy and hold, like at the end of the day, when you buy a stock, you're buying it for what somebody else sold it for. Like at the end of the day. So if you buy Apple at 169, somebody else just sold Apple at 169. That's why they're shares.
So let me ask you a question. And I know we're almost at the end of 2023. If you got started in 2020, what is your portfolio? How does your portfolio compare from 2021 to 2023? And take out 2022, because I know we had a lot of pain in 2022. Do you feel like you have is your 2023 portfolio outperforming your 2021 portfolio? Or are you able to answer that? Like I know, because you probably didn't have a chance to look at that.
Yeah, no, I don't remember off the top of my head. I don't remember exactly like what my returns were in 2021 versus. I know in 2022, is like when I really like 2022 and 2023 had the same strategy. Like it was 2020, 2021. It was like revolving strategies, trying to like find my identity as an investor kind of thing. 2022, we had a bad year. I think the S&P was down 19% or something like that.
Yeah.
I think my portfolio was down like, it was like 7%.
Oh,
so
good.
like I did really good. Like that's at the end of the day, like coming from a saving mindset, like you're just like, man, you lost 7% of your money, but like it could have been worse. So it's one of those things. And then this year, I've been competing with the S&P 500 all year. And at the end of the day, like, would I be better off just like both in time management purposes and stuff like that, just investing in the S&P 500? Yes. But I also am doing it, one, because it's fun. And then two, I have the YouTube channel. How boring would my YouTube channel be if like, yep, today I bought the S&P 500, tomorrow's video, hey, I bought the like that would, nobody would watch that. So it's kind of for the entertainment, but I also do that in my Roth. Like my Roth is 6 ETFs and Tesla. That's all I have in there. And I just buy those and I just go about my business. I have VOO and I forget the name of the real estate ETF, SCHD, QQQs, like stuff like that in there. And I just, put the money in, leave it alone. So, I do that with, and that's like the tax deferred one. So that's going to be cool. Whenever 59.5 comes around, it's going to be nice to get that. So, but like I said, I'm really curious to see where the year ends. Cause like the S&P has been like, have a really good day, but then it had a bunch of bad days in a row. So I'm really curious to see where we settle at the end of the year when I do my like end of the year recap. I'm excited to see if I don't think I'll catch the NASDAQ. I need the NASDAQ to have a bunch of bad days. Cause the NASDAQ was like up like 38% at one point. I'm like, all right, that's not fair. But, yeah, we'll see. I don't know if that directly answers your question or not, but it's, the loss I don't remember what my performance was in 2021. I think I have it on my spreadsheet, but I don't look at that too often. That is my goal though. Like to answer your point, like I'm not one of the many YouTubers or people on Facebook that it's just like, oh, I'm going to, invest in this just to get my dividends to go higher and focus just on the projected annual dividend income or anything like that. Like my goal every year is to be in line or outperform the S&P 500. I mean, one of my 3 simple metrics is outperformance of the S&P 500 over the past 10 years. Like that, I don't even look at stocks that don't outperform. Like to me, that doesn't make sense because my job and my goal is to make the most amount of money. I understand past performance doesn't guarantee future success, but like, would you rather the company never had outperformed the S&P 500, but promised to do it in the future? Or would you rather a company outperform the S&P 500 in the past and then promise to continue to do so? Like to me, they have the track record of being able to do so. So I invest in them. So, but yeah, did that answer your question at all?
Yeah, it answered it. I just feel like so many people, I mean, back to the psychology of it, so many people went shooting up in 2021 and then they are the market. They pulled out obviously in 2022 and then limped back in if they did like into something and just said, no, I don't want to, I don't want to care about it as much. And I'm not in that category. I'm pretty up from my dollar cost average in almost everything that I own, but I still also have 50% of my portfolio is ETFs.
Yeah.
So the rest of them will be strict dividends that I like, and that's been proven. And I try not to look at it, honestly. First of all, I don't have time. I used to look at it a lot more, but I just want it to grow and not to try to do those risky plays. But if I feel like something is, if I feel like the year, I'll look at trends at the end of the year. And I feel like something that I'm in did not perform the way I would want it to perform, especially in my active portfolio that's not my Roth. I'm happy to sell it at a loss and take the tax write-off because I feel like I can grow it better somewhere else the next year.
Yeah.
So I'll do that in December. I sell off. So I lose a little bit, right? But I feel like over time that's worked for me because my portfolio continues to stay up.
Yeah. I mean, that's the correct approach too. Cause what do we there? I forget what investor says this, but he's like, a lot of investors will, trim, what do they say? Trim the flowers and water the weeds, where they're just like, oh, okay, we're going to take money off the top of our winners and then we're going to put money into our lower performing positions, dollar cost average, which that is a strategy. but it's one of the, like, sometimes you just overthink it. And then same thing with, you talk about like not selling, like you just kind of buy and hold, and you just, stay out of your own way. Because a lot of people, like you said about 2021 being very good, followed by 2022 being very bad. A lot of people, when you mentioned it, it made it seem like people were smart enough to pull out while they had the gains. But what happens is they probably lost all, if not more than the amount of money that they made. So now they're underwater because they waited in 2022 to sell. And then now, like, that's when those people get in, like, investing's a scam, or I'm not doing that. Like, other than stepping back and realizing that they didn't have a plan, they didn't have a strategy, they don't have goals. Like, they were just investing because everybody else was investing and they heard everybody can make money or whatever. So, and then a lot of people got in, in 2020, 2021, and they were under the impression that, like, investing was easy. It would only, everything you bought just went up and stuff like that. And then 2022 hits and reality check sets in. And that's where you really start to weed out, like, the real investors versus the not real investors. And personally, I think everybody should be an investor. It's just, like you said, you have your 50% ETFs and your stocks, but you also enjoy the stocks. You enjoy looking for the individual stocks. And maybe if you can't find anything that you want to buy, or you do want to be more hands off, that's when you add to your ETFs. So I feel like everybody should have, like, some kind of level and balance with that. Like, how active do you want to be? If you want to be really active, maybe you only have 10% ETFs or no ETFs, or, like, maybe just like me, I have all my ETFs in my Roth account, and then all my individual, but I only have 11 holdings. So, like, it's one of those things. I don't have a ton to research and stuff like that. And really, I don't research much on the stocks now. Like, I identify those as good buys and why they're good buys and why I want to invest in them. And then I just keep investing in them. And one of the ways I'm able to take emotions out of the market is I dollar cost average, and I do it every day. So every day at lunch, I put $2,000 in every month. I have my 11 positions. I have how much I want them to weigh. I have a little chart at the bottom that tells me, okay, if you want, every day you have 13 trading days left, this needs to be 8% of your portfolio. Here's how much money needs to be in this position. Here's how much this $15.14 goes to Apple every day. So I just do that. I look at it, obviously, because I have to buy them. Like, if it's up, 80.86% or what. But, like, to me, I'm just like, every time I look at that, I'm like, oh, cool. Next Era Energy's, that's the one that's killing me right now. But Next Era Energy's down. And I'm like, cool, I'm getting it for cheaper than I got it yesterday or whatever. So, like, I just take the emotion. Or if Next Era Energy has a good day and it's up 5%, I'm like, okay, cool. Like, the money I had in there is now worth more. It's more valuable. I gained 5%, but now it's going to cost me 5% more for the same shares. So, I literally, like, silver lining in whether the market goes up or down. And I feel like that helps me be emotionless in the market. So,
well, I want to go back to something that you said. You said you think everybody should be an investor, and I agree with that. And you also said, some people just will say it's a scam. So I'm going to ask you this, because this is what I believe. Do you believe it's a form of gambling? Because I actually do believe it's a form of gambling. And to follow up, a belief that I have is, even though I think everybody should be an investor, if some people aren't losing in the market, then it doesn't work, right? It doesn't work for people to actually make the gains that they want. If everything's going to always go up and never pull back, wouldn't make sense for them to pay dividends, for instance. It wouldn't make sense. You know what I mean? Like, the big market makers, they would pull out, like, they would have a different strategy. So if everybody was winning all the time, a lot of people would not make money. So how do you feel about that?
So as far as the investing being gambling, I guess it depends on the technical definition of gambling, or, like, what people consider to be gambling. To me, I feel like it can be, anything could be gambling, because if I think of what my definition of gambling is taking money and putting it into something that you're taking educated guesses on what you think it'll do, but you don't really have control over. So the difference between that, like, the thing that would separate generally investing versus gambling to me is I technically have control. Like, we'll go back to Pepsi. I technically have control whether Pepsi does well or doesn't. Like, obviously to a very small extent, but, like, if I go to the store and I'm loyal to Pepsi and I only buy Pepsi brands and stuff like that, I'm contributing to their bottom line. And if I own their stock, then I'm helping their stock do better. So, I mean, versus, like, gambling, like, if you're playing freaking roulette or something, like, there's nothing that you can do that changes whether, I think roulette's the one with the red and the black, like, the little wheel. So, like, there's nothing you can do to help your cause if you just put everything on black. Like you have, like, there's nothing you, so I feel like that's one of the differences. But yeah, I mean, some people do treat investing like gambling, where there's no education to it. They're not doing anything to help their investments. They're, like you said, they're doing the investing off of fear or emotions or whatever. Just because, you know, so-and-so bought this, they made a lot of money. Somebody made a YouTube video on it. Now they're buying it. Like they have no, and I talked about this in my last interview, is like, those are the easiest, people to flip-flop, to sell and, you know, buy a lot, not necessarily buy a lot, but they buy and they sell like so flip-floppy, is because they have no conviction on their own. So they go into a Facebook group, everybody's talking about, you know, Neo or whatever. Neo was a stock I bought when I just listened to people, and Nvidia was a stock. When I joined that Dividend Growth and Investing Facebook group, everybody was talking about Nvidia. Nvidia did really well for me after a while. It was down for a long time, but then it shot up. I sold it right before earnings, and we all know it went up, you know, 25% after earnings, because why not? But like I still made 55% on that. But the reason I sold is, one, because I didn't convince myself that I wanted to buy that stock. I let other people do that. And then two, it didn't fit my 3 criteria that I have. Like it outperformed the S&P 500, but it didn't have the dividend streak and it didn't have the dividend growth rates. So like, I was like, okay, 55%, and I can take that money that I had in Nvidia and the money that I gained from Nvidia and put it in a stock that does meet my criteria, that I can convince myself that I like, which was Costco. And I've done very well on Costco. Like I'm up like 16% since like May. So I'm doing really good on Costco. And it doesn't seem to go down ever. I bought it at like 494 or something like that, and it's getting close to 600. Like it's just,
That's because they're taking all of my money.
yeah. See, but so that you could be gambling into Costco, but you're also making sure Costco succeeds. So I appreciate you. So yeah, I don't know if that answers the question directly, but like that's just kind of what, like, I'm trying to think of that on the fly. I think that you can do investing exactly like gambling, where there's no impact from you, there's no knowledge from you, you're just buying whatever. But I feel like one of the differences is that you do have some kind of impact, especially if you're doing successful companies, or even whether it's, you know, AT&T and Verizon. I personally don't like either one of them, but if you pay an AT&T or Verizon bill, you're technically trying to contribute to their success.
Yep.
So
I agree 100% with all of that. I just also believe that, you know, it's just like you said, I'm propping Costco up. They're taking all my money pretty much. And so I'm the reason their stock's going up.
Hey,
but
you get a free sample every once in a while, so it's worth it.
Exactly. Realistically, though, we are a small portion of that. So we only have a teeny tiny, you know, thing that we contribute to this stock. And so what we really need is everybody else to also believe in it and contribute to its product, not the stock, in order for it to continue to succeed. And so if you think of it that way, then, you know, you could win or lose. I also think you could win or lose on any investment. I think you could, I'm of the belief that really you just have to be smart about what you're doing. But to actively promote people into coming into investing, I do it too. And I think that they should. I think everyone should do it, maybe by watching your YouTube channel, by having a strategy, by really being smart about it. So one of my strategies is, and I told you the 50% and then others, I bought Nvidia. I still hold Nvidia. It's up. I got to ride it up. And then of course it went back down. But I also believe in the future. And I try to see what are these companies doing. And I think Nvidia is one of the main things you can invest in for AI and technology and all of that. And so I want to be, you know, everybody wants their Apple, you know, or whatever to get in from the ground up. And I think that Nvidia is one of those that it will continue to perform, and it has a long way to go, especially where we're going in the future. So I love that. But what I'm trying to say is, you know, there are always going to be winners and losers in the stock market, especially uneducated, emotional people. And in a horrific way, we need those uneducated, emotional people to be the market so that we can win.
Well, I mean,
and that's horrible to think about. We have to have people lose.
Yeah. Well, like even me with Nvidia, I don't remember exactly what I sold it at. For sake of argument, let's just say I sold it at 320 and then it goes up to 400.
Yep.
somebody benefited by me being like my decision. Like, I don't want to say it was uneducated because I had my reasons for selling,
Right.
but like somebody bought my shares at 320 a share and then it
Right.
went up. So like you need people like me, or even worse than what I did, where they're just like, oh, Apple's not really doing well for me just because I bought it at a bad time, so I'm gonna sell Apple. I'm like, well, like, is it ever a good idea to sell Apple? And like what you were saying about Nvidia, I agree with everything with Nvidia. The thing that I think I just read an article, I don't know, a week ago. I don't do a lot of reading. I prefer to like listen and watch than read. But like even the newsletters I get, I highlight them and then right click and hit read aloud. So it like reads it to me and I just like follow along. I just grasp things better like that. But the thing that I read, or that I had something read to me, was that Microsoft is about to release their AI chips to compete with NVIDIA. And to me, it seems like in America, it's always let the biggest and best win. And Microsoft already has the moat. They already have what they do. And they have other products other than these chips. So if Microsoft decides to get into chips and they can do it just as good as NVIDIA, they're going to take that market share because they're Microsoft. So like NVIDIA to me, and like this isn't a bash on anybody that owns NVIDIA. Like I said, I did own it and it's done very well. But it's one of those things where like, if that's all NVIDIA does, that's scary to me. It's just like the difference between Coke and Pepsi. Like if Coke only has the drinks and like something happens with that, they're kind of screwed. Now, it's Coca-Cola, like freaking Warren Buffett owns it, so it's probably not going anywhere. But like Microsoft has other things and they're doing this chip. So they're like, hey, we recognize these people coming over here. And then Microsoft's invested into OpenAI with ChatGPT. Like it's just one of those things where it seems like the big people always end up winning. So that's what I have. Microsoft, I have Apple, ExxonMobil's and Chevron are the two biggest oil people. And like oil's not going anywhere. And Exxon actually announced that they're going to be opening an EV. Like they're doing batteries, so they're going to be trying to get into both. And I don't think Exxon will ever beat Tesla because I think Tesla is the leader in their space. But if Exxon can start taking some of the, or not even taking some of the market cap because they're not going to make cars, but like if they can start like Hondas and Toyotas and all these guys, if they're not getting on the Tesla bandwagon because those are direct competitors, they might go into Exxon, which helps Exxon because I own that one. So it's like, oh, oil and gas, if they start reducing the production of that, then, Chevron might be screwed, but Exxon's not. So it's kind of one of those things. So I agree with everything you said, especially with the NVIDIA stuff. Like they have a really good runway. The thing that makes me nervous, and this is just new, like this wasn't a decision of why I sold it. I just heard this, but with Microsoft getting into that, like not to say Microsoft or, Facebook or Apple or those guys don't make things that don't work out for them, but like they're as big as they are for a reason. Like most of the time they do stuff, it works out. Even if it's just brand recognition. Like I think Apple's little glasses things that they're doing, I think those are ugly. But just because it has an apple on it and it's like made in a cool, they have a little warehouse that's got like white lights and like just because of that, like they sell more than they should.
Yeah.
So
I agree with that. And I love that you said that. First of all, I also own Microsoft, but that's also one of my strategies. Like I will, for what I believe in, I buy that thing and I buy its competitor if there's a competitor out there, because I feel like I'm going to win either way.
Yep.
For one thing, I believe in where it's going. And for another thing, it's like if they have a direct competitor and the competitor wins, I'm going to win there.
Yeah.
So, in some ways you can't lose. I mean, you can't lose.
Do you typically go even with that? Like, do you have the same amount in Microsoft as you have in NVIDIA, or how do you handle that approach? Because I mean, technically you could be like, I have a better conviction in, Pepsi instead of Coke, but I have, 40% in Coke and 60% in Pepsi, or how's that work?
I was buying Microsoft before NVIDIA, so it's always going to be a bigger position.
Yeah.
So no, not necessarily, but I'm happy to ride the wave up. But yeah, that's a good point. Probably if I started both at the same time, then I might would do the same.
So do you have Home Depot or Lowe's?
I have Lowe's.
Okay. So I was trying to think of like competitors that you could buy at the same time that you don't have. So like if you did start it in like Home Depot and Lowe's at the same time, like do you think you would, assuming that because you have Lowe's and not Home Depot, that you like Lowe's better, which I think I agree with that. Like just based on like when I do my Power 5, I was just talking last week. Yeah. When I do the research for these, it was kind of annoying when I first thought about it that like every quarter I do a video, it's going to have roughly the same list of stocks because most of them are quarterly pairs. And I was like, man, like it kind of stinks that like last time I did this video, the same stock was the best 10-year returns, and I'm mentioning the same thing. Like I like the variety idea, but and with the guest I had last week, I was kind of like thinking through it. I'm like, well, if you think about it, it's kind of a good thing that every time Lowe's is on this list, Lowe's is always the leader in X, Y, and Z category. I'm like, that shows that not only did we have a good quarter, but like every time they have the opportunity to win a category in the Power Five, they're doing so. And like to me, it's almost more of a red flag if like, oh, every time, say this week this stock was the best 10-year returns, but then next quarter when they have a chance to do so, they're like not even in the consideration anymore. And I'm like, well, like what did we just catch them at a good time last time or whatever? So it's kind of one of those things. So anyway, Lowe's is always on there. Lowe's always wins. Seems like more than one category, which is cool because they have like a really long streak, really good dividend growth rates, and good 10-year returns. So, but like, how would you pretend you don't have Lowe's and you were starting positions today and you were going to buy Lowe's and Home Depot? Would you do 50-50 on that or?
Probably. I do. So when I add a stock to my portfolio, especially if I'm not taking one out, I just end up putting the same amount of money. Like let's just say it's $50 a month in each one or $100 a month in each one. I stick with that. Like I don't care about this stock price necessarily.
Yeah.
I just put the same amount in every single one.
Well, that's
because then it gets too like I'm like I don't know.
Well, so you brought up. I don't know if you've seen my video. I don't know how long you've been subscribed to the channel, but a while ago I made a video called like stock price doesn't matter. And the point behind that was exactly what you said: dollar cost averaging and fractional shares. Because especially if you have a long time horizon, like it's not going to matter if you buy Apple at 162 or 163. Like 20 years from now, you're not going to care. And like what a lot of people do is they're so gung ho on buying a certain stock at a certain price because they're feeling like they're getting a deal that they refuse to buy it until it gets to that price. And sometimes it never gets to that price and they never get to own a good company. Right. So like, it's just one of the things, like, of course, when I get like way closer to retirement, like at that point, evaluation and stuff like that matters. Evaluation of the valuation will do that. But that stuff actually starts to matter because I don't want to buy something at an all-time high because I don't have the time to let it, figure itself out. But like for now, like there's so many people. It's another way I take the emotions out of the stock market. Like exactly what you said, when you're buying Home Depot and Lowe's, like in this theory, you're going to buy $100 of each one every week or every month or whatever it might be. And you don't care if Home Depot just went up 3%, if Lowe's just went down 6%, if Home Depot costs $400 and Lowe's cost $178, like it doesn't matter. And something I actually just learned recently is a lot of people put a lot of focus into like P&E ratio, price to earnings, and they do it to the forward, which I think is crazy. Like I was thinking about actually making a video on this because it blew my mind when I heard it, but they do it on forward price to earnings, which the price to earnings in the forward is literally projections from the analyst of what they think the earnings will be relative to the current price. So the current price is obviously fixed, but you're basing your buy off of somebody's guess. And how often, like literally every time they report earnings, the goal was for your company to beat those earnings. Yeah. Like that's when the stock price. Yeah, exactly. So you're just like, okay, like I'm going to base this off of this number saying whether it's too high or too low or just right to buy. But these guys just made a guess. And most of the time they're wrong, whether it's up or down, whether it's an earnings beat or earnings miss. Like, I just thought that was wild to me that like people, because I don't look at the PE ratios at all. Because like PE ratios between sectors are so different. PE ratios between the industry and the sector is so different. The sub-industry, certain stocks have a premium over other stocks. Like Costco is never affordable according to their PE, but they always outperform the S&P 500 and they have good track records and all the things. So like if you're waiting for the perfect time to buy Costco, you're never going to own Costco.
Right.
So I don't know. I don't know how we got on that.
I don't own Costco. I need to own Costco. You're selling me on Costco.
Yeah. What the heck?
See?
Why don't like they have
now we're this psychology here.
Yeah. The outperform. Like look, obviously do your own research, but the outperform, they have a dividend streak. The dividend growth rates are really good. Like their yield's really low, but if you're not a yield chaser, then it doesn't matter.
Well, I went down to outside of what I do for my retirement at work because they use TIA CREF, which I don't know if you know any of that, but you can't pick. You can pick what you want to be in, but you can't pick stocks or even ETFs that are well known. They're like an insurance annuity. So they pick batches of things, and then you can say, I want a batch of real estate, and then they choose. So it's horrible. And
Do you
I
okay,
hate it.
off topic, on topic? Do you think that the people that are making these retirement plans within workplaces actually invest? Because like half the options
I
they
don't
give,
think
I'm just
they
like,
do. I don't, because when I look at what they're doing, I'm like I can determine like I want 50% in real estate, but it's their picks, their real estate batches. And it can have all kind of, because they basically what they do, CIA CREF is, and I could butcher it, but they like take an insurance policy out on these things. And so it's like a policy on a stock holding or something. And it's so ridiculous. And it's supposed to guarantee that you don't lose. And they talk about all of this, but their management fee is so high. I'm like, ugh, it almost kills me to think about their management fee, because it's like I could make so much more money if you didn't charge that much on a management fee. So I have to do that. So that's like the safest, whatever. I'm like, okay, you guys pick. I mean, I do determine I want this much in real estate and this much here. No government bonds for sure. Don't do that to me with your management fee. I will make nothing.
yeah, you'll
So,
owe them money. Yeah.
yeah. So outside of that, I whittled it down to, and I couldn't tell you right now, but between ETFs and stocks, I whittled it down to 20. That's a lot more than what you have. But I felt like I got to pare this down so that I can have bigger chunks
Mhm.
of a company,
Mhm.
right? So I guess Costco just wasn't one of the ones. So now that you're saying that, I need to go back and be like, which one do I need to let go? Because I will say, every December I let one or two go
Mhm.
and figure out something else. So
Yeah,
I need to figure out what that's going to be. Maybe Nvidia,
yeah,
since
yeah. There you go. Hey,
Microsoft's
yeah. See,
taking it.
look, you're gonna add
I'm
some more to
up.
Microsoft, and yeah, there you go. But yeah, I like Costco. Like I said, obviously I like it because it's up a lot. But I like NextEra Energy too. I think that they're just having a really bad year. But I'm doing phenomenal at lowering my cost basis this year. Like my cost basis
Oh,
on
that's
NextEra
awesome.
Energy's gone like way down this year, which I'm really curious. I think I don't know, maybe for this next month recap or the one after that, I'm gonna go back and like watch my January one that I put out and just see like what the cost basis of some of my positions were in January and see where they're at now, just for funsies. But okay, so next question. I think you kind of already touched on this, but this might give you an opportunity to talk about what you were talking about before the interview. So how has your investing style changed from when you started to now?
Yep. So I used to be, I'm a nerd. I love investing. I'm even in the crypto space, and we won't even talk about that. I still believe in it. I am in it. I'm up. All my positions in crypto are up. I got in very early, so I feel good about it. But I used to watch videos like, and it would send me down um, these paths of I need to invest here, I need to invest there, and I would just like consume so much that it's almost what they call analysis
Mm-hmm.
paralysis, right? Like you're consuming content, and you're not taking action on what's right. You're just loving the content. But I love learning about it. So I was thinking I had this belief that real estate, I want to hold real estate later, like as an investment properties, just hold investments, because I think real estate beats a lot of things, even when it goes down over time. I think real estate's the way to go. But I had this belief of, well, you have to have a lot of money to buy real estate. And I don't have that kind of money. I'd rather just invest in my portfolio. And I learned after a YouTube, trail, that you can actually invest in real estate without owning real estate, and I'm not talking about stocks. So you can help people who are wholesaling real estate, or fix and flippers, or even people that are buying real estate for investments. So when they're out there buying and they're trying to get low cost into a real estate investment property that's going to cash flow, they're not going to they don't want conventional loans, and they don't want their credit hit all the time. And they also, a lot of times, don't want to use their own money for these investments, just because they need liquidity in the bank, so that if they ever go to refi at a lower position or a low interest rate, then they have the the what the bank would want to see to have a refi. So I realized just after growing my network and talking to a lot of people that were in real estate, I realized that you can make a pretty good amount of money just lending to people as a private money lender. Now I'm not accredited. It's friends and family type thing. So if you know people who are in real estate and they go in and they need, they can get a hard money loan to flip a property 3 to 6 months really easily. But what the hard money loan won't give them is that extra 20% that they would have needed to put down. And it is risky. It's very risky, but I've matured in what my risk tolerance is now, especially if I meet people who are doing lots of deals, turning over lots of property. Like I have people in my network who they're doing, 3 to 10 properties a month. So I feel like they own enough property. So if something went wrong in my investment, I could get it back. So how this would look is they need a property, they go get a hard money loan, and they say, let's just say they bought it for 200,000. So they need 40,000. Yeah, 40,000 down to put on the property to close, to purchase it. And they would say, hey, I will pay you, I need this 40,000. I need it for a short period of time. I will pay you 20% cash on cash, no APY, none of that, 20% for 6 months. So I put my 40,000 and I make 20%. And after 6 months, they pay me out. They also will pay simple interest along the way. And so you put a second lien on the position. And so if they defaulted, the hard money people would get their money first if the property had to sell or you had to foreclose on it, and then you would get your money after that. But I don't do it with brand new people who don't know what they're doing. I only do it with people who also would cross collateralize or put a personal guarantee. So I know they have a lot of liquid in the bank. So if something went wrong, they would just have to pay me out of their own money. But I'll do that. And then also I realized like one day I'm out there, I already have my money out there, and other people are like, hey, can you lend? And I'm like, no, can't do it. I'm tapped out. And they're like, do you know anybody else? So it's like, maybe. So, I go recruit other people, friends and family, of course, not a broker, none of that. Like, so I'm basically using my time to go find people, and I'll say, okay, yeah, you're going to pay them 20%, 15%, whatever it is you're offering. I want 3% of the loan. So I don't do anything. Like I literally just connect people together and then maybe take 3%. So it's done really well, Troy. So September, I just started that portion of it and being like a connector, I guess. And in September, I made 2,500. In October, I made 12,500. And then November, I've made about so far close to 8,000. So I'm hoping to beat October just by finding friends and family, doctors, whoever that I know, and say, hey, invest in this, grow your money. I know these people who are doing deals.
Do you like I said before the interview, like I've never even heard of that. So 2 questions. I'm gonna ask them both because I'm gonna forget them. So first question is, do you think that the being the connector role is more your style because it seems like it's a little bit less risky and you don't have to have as much capital to do that versus you being the one to loan the 20 or 40? And then second question is, do you see interest rates and housing and that whole, convoluted situation, do you see that impacting for the positive or the negative side, like in the future?
I think it's impacted negatively. Interest rates have impacted negatively the regular Joe that's going to buy a house for sure. It's going to make property values fall. I do think it's more risky to loan your own money. So I wouldn't just loan anybody money off the street. Like I know people that are active real estate investors. Those are the only people. Like I would never recommend just going to find people and say, hey, I can connect people together. I think you could get yourself open up to a lot of even legal things. Like we're talking friends and family people, but people. You Troy, you probably know people with money that you don't even know with money. Like your brother or whoever. I don't know if you have a brother, but somebody that says, hey, do you want to keep your money in the bank? What do you want to do? You have savings. Do you want to deploy it? Here's a risk involved. So, yeah, it's high risk, high reward. The connector role is definitely less risky, but I don't ever, you know, I always tell people it's risky, and I only take money from the borrower. Like, I'm not some advisor or broker. Like, I don't take money off the loan itself. Like, I'm not going to say, okay, loan them a little bit more and I'm going to take some off the top. I don't do that. So with the lender, I want them to be as safe as possible. And I only introduce people who I would personally loan to. Mm-hmm. And as far as the investors that are doing these things, that are buying properties right now, and this is a whole other conversation and we won't get into it because I know we're talking about dividends and the time's going long, but I'll tell you this one thing. You can actually go buy an interest rate from someone. So you can buy a mortgage and transfer the deed, so you still own the property, but you keep the mortgage. And so what investors are doing right now to get around the high interest rates, or they're going and buying investment properties and talking to people, maybe a military person who has to leave because they're being transferred, and they bought at the 2021 and they got a 3% interest rate, and they come and say, I've got to sell the house. Nobody can buy it because they don't have a lot of equity in the house. And so an investor can swoop in and say, I don't care about the equity. I'll pay your total asking price. I just want your interest rate. So we keep the loan in your name, but I take over the deed, and that's how they're doing it.
So that's we'll definitely have to talk after or later, because I refinanced. So I got the house in 2018, 4.625 interest rate, refinanced in 2021, 2.75% interest rate. I wanted to rent it, but I don't know if I want to be a landlord. And I could take that capital, because I both in the capital appreciation of the house over time, and the fact that I was able to put down like 45% on the house when I first got it, I have a lot of equity in the house. So that's why I was like looking, I was like, okay, if we sell the house and we're able to save a lot of money between now and the time we're wanting to build, I can put down a giant chunk, like maybe half or more on the next house. But like, I know this smart investing decision would be to somehow find a way to keep this 2.75% interest rate, because like that's free money at this point. So I might get with you after that, just to like try to figure out like what your ideas are on this, because I just had a conversation last night that's making me lean towards the renting side again, or something along that lines. But I don't know. The difference is like, okay, do we put down 100,000 on the next house, or do we put down like 250? If I sell this house, and it's kind of like, okay, well, yeah, the interest rate on the new house is going to be 5.5% or whatever versus the 2.75. I don't know. So like you said, we'll get into that later, but definitely interested in that. Okay, so back to the dividend side of things. Do you have any short-term goals, like maybe that you hope to accomplish in the next like 3 to 6 months with dividend investing, and then like what are your long-term goals with dividend investing?
My long-term goals is to just, it's hard. Like, I don't have specific concrete I have zero short-term goals, but I don't have specific concrete long-term goals other than to evaluate over time. Like, I'm not blind to my portfolio so much that I don't care how it's performing. So I do a year over year. How did I do compared to last year? And then I take into the market, like what happened in the market. But I pretty much do well year over year. I reinvest my dividends, and so I'm hoping for, this is it's a long-term play. So I just hope to make sure. I think over time I will even shrink my portfolio even more, honestly. So that is something that I'm looking into doing. But yep, no real goals other than to make money.
Yeah, I mean that's everybody's goal. It should be everybody's goal. Okay, so this is going to be a good question for you, because you did mention that you do sell at least like 1 or 2 positions, it seems like, every year. So do you have any stocks that you regret selling? Like maybe it did have a bad year, and then after that it seemed to do well, like once you got off board, and then stocks that you have like buying brags, like one that you identified at a lower price and now it's done very, very well for you, kind of like Nvidia.
Nvidia would be my only brag. The other one are boring. I'm a boring investor when it comes to stocks. But the one that kills me is Tesla. I sold way too soon.
Was it because you were down, or you just didn't believe in it anymore, or you bought it because somebody else told you to, or?
I was up, and I did not realize the upside that it had.
Mm.
So I was like, there's no way. I mean,
So you trimmed your flowers.
yeah,
Yeah. That's
but I could have made so much more. So
but you said you were
it
up,
was,
right?
I was up. I
Yeah,
was
so it's
up.
kind of like me with my Nvidia position. Like I could have made a lot more, but like nobody's ever, went broke taking profits. So, I mean, yeah, it
That's
does
true.
stink. You could have made significantly more. I could have made significantly more, but like at the end of, especially if you deployed that capital in something else that's made you money since. So, like
Yeah.
it's not only the whatever percent profit and how much dollars you made off of that position, but it's also the selling the profits and selling the position, taking all that capital and putting into something else that since you've sold Tesla's made you, 10% year over year. So it's kind of makes it a little bit better. I mean, you're not probably going to outperform Tesla's performance, but that's why I have it in my Roth because it's going to freaking keep doing whatever it's doing and I'm just not going to touch it. So,
I
um,
haven't bought back in.
yeah.
Yeah, it's like I don't know what.
Yeah.
It's one of those things. Maybe I'm still regretting it. It's
Well,
like
at the end of the day, like the argument with buying back in on a stock that you did make a mistake selling is the most of the time the reason you want to buy back in is because it's gone up. So that's could be a case of like compounding your mistake. Not only did you sell it when you shouldn't have, but now you're spending even more money to buy it back. Like for me, I could have done that with Nvidia. Like, oh, 24% after hours. Like I need to get back in because it's going to keep going up. But that's when the emotions start creeping in. So if you can like take a step back and be like, okay, I maybe quote unquote made a mistake. At the end of the day, you made money, so you didn't really make a mistake. But like I quote unquote made a mistake. Don't make another one by buying it when it's too expensive just because you're mad at yourself for making that mistake. So
right,
obviously do
right.
what you want, it's your money. But like that's my way of taking the emotion out of it is like don't compound the mistake by making two of them.
That's
So
right.
so there you go. Not professional advice. Okay. So do you have? So we know dividend investing is a long game. You've been doing it for a couple years now, and then you plan to do it for a bunch more years. So
Right.
since it's a long game, and if you do it right, it does seem to always work, but it does take a lot of time. So with that being said, do you have any dividend milestones or achievements that you've gotten like recently or you have gotten in the past, and like what role do those play in like keeping you motivated to keep going?
I No, I don't necessarily have any dividend milestones, but I do want it to be a hedge to hedge my bets for retirement. Honestly, I want to be able to have a portfolio that's earning enough dividends that I don't have to touch my stocks when I retire,
Mm-hmm.
when I'm less actively investing.
Mm-hmm.
And so I need to sit down and do that. I don't know what that looks like because I have so many other things happening and so many other things that I'm hoping to happen with retirement. So it's like, how much do I really need when I retire and what year am I going to retire? I recently switched jobs. I was in the government sector. I still kind of am, but I had a sweet pension, right? And I only worked 20 years and I should have worked 30 in order to get the full pension. And now that I'm not going to get the full pension, I still get the 20 years. I'm going to need more than I originally thought I needed. And so I'm probably going to work longer than I thought I was going to have to work. So I think I need to decide like what Social Security, if Social Security is there, which I think it's always, everybody says Social Security is going away. I think that would be a political nightmare personally. So I
Mm-hmm.
don't think they can let that go away, but I think it'll change significantly in the future. So what does that look like? What does my pension that I already have look like? What do my other retirement portfolios look like? And ideally, I'd want a dividend portfolio that I could just live off of that and keep the main thing. So I need
Yeah.
to determine what that is.
I mean, that kind of ties in really nice to like the next question or topic is like whenever. So I guess your answer is going to be something along the lines of like you have to still figure that out. But like when you're trying to figure this out, so the question is like how and when do you know when enough is enough? But like specifically for your case is like what kind of things are you going to be looking at to help you decide what number is your end goal?
My lifestyle spend. I want to live all the way to the end, Troy. I want to still travel. I want to still, I think we're here and some people, so there are characters of people. Some people are just spending all their money and they don't save anything, they don't invest anything. And then other people aren't, they invest and then heavily if they're super into investing, they tend to be very frugal because they know the value of compounding interest and
Mhm.
whatever else. I want to live the end of my life in the middle. Like I don't want to have such a frugal mindset that um, I've missed the joy of life. And I'm trying to, even as a middle-aged woman, trying to start that now, right?
Mhm.
So I think my what I do in my lifestyle, I spend more money than I ever used to spend.
Mhm.
Um, I make more money than I used to make, but it wasn't that I always had a lifestyle creep. It's that now I have just a different outlook on, I want to experience joy, and what does joy look like for me? Well, it may look like sitting on the beach for a week. You know what I mean? And I want to be able to comfortably do that and not have to save every little penny to do it. Like I might want to go to the nice resort sometimes,
Mhm.
and I used to be one where it's like the cheapest plane ticket, the cheapest, and I still buy the cheapest plane tickets actually, but like the cheapest hotel, the cheapest everything. And I want to, so figuring that out to answer your question is, what kind of lifestyle do I want? Do I want at the end of my life when I decide to retire? Well, it's one of, I want to have an active lifestyle that's fulfilling. So I'm going to need more money than I ever thought I needed. I don't want the bare bones to get by to pay my living expenses. Now, I don't have to live in the biggest house. I don't have to have the best car. Those are things I don't really care about. So that will come into play. Like I can sit in, as long as it's a safe, nice community, I can sit in the same house and be fine there. So it's not like I'm trying to acquire so much and live in some huge mansion. That's not me. But it's going to be, how I figure it out will be the amount of money I need to have a enjoyable lifestyle.
Mhm. And that could be like a percentage of what you think. Say your expenses per month are $5,000. Like maybe instead of shooting for $5,000 in whatever source of income you're getting, maybe it's 10,000. Where you're like, hey, I'm doubling
Exactly.
my expenses, and your expenses are how you're currently living, but accounting for
Right.
inflation and also things, you doing a little bit more since you're gonna have more free time. You're gonna have more time to do things that aren't free.
Right.
And what you were, one of the things that you mentioned earlier about like lifestyle creep, I feel like there is like, I wouldn't even call yours lifestyle creep. To me, the definition of like lifestyle creep is like people not realizing that as they're making more money, they're spending more money. And you're fully aware of it, which is different to me. Like that to me is like you figuring out what you do, like you said about the house and the car, like things that you do and do not value. Like now you're going to value places you get to go, things you get to see, things you get to do over where you sleep and what you drove to get there. Like it's just,
Exactly.
and to me, like I want a nice house, but I don't need a mansion. I want something I can be proud of and also take care of. And then I've always wanted a Tesla. I've driven them like 8 times already. They're freaking phenomenal to drive. But my car, I paid off my car already. It's got 50,000 miles on it. It's a Subaru Impreza. It's done. It's mine. So like
Yeah.
it doesn't make sense for me to buy a new car. So I'm going to wait till
Right.
mine blows up and then I'm going to get my Tesla. And then like Teslas, there's reports of them lasting 3, 4, 500,000 miles. So like
Yep.
that might just be the car I have, not for the rest of my life, but for a big chunk of it.
Right.
So it's one of those things. And so it is figuring out what you value. And like I said, there's a difference between lifestyle creep and acknowledging things that you do and do not care about and like making sure you have enough money to do whatever it is you care about. Like to
That's
me, I'm a
right.
big Thunder fan. I've been to 228 straight Thunder games. So
Wow.
like home games, obviously I don't travel with the
Yeah.
team, but like that's a thing that like as long as the Thunder are in Oklahoma City and I'm still able to go to the games, I want to go to every game I can go to.
Yeah.
And it might look like as we get, I don't like sitting courtside. I've sat courtside, not on the court, but I've sat like 1 or 2 rows off the court a couple times.
Hmm.
It's fun for different reasons. Like you get to hear the coaches and players and stuff talk to each other, which is fun. But like it's really
Hmm.
hard to actually focus on the game because like you're constantly turning your head back and forth, and like you're just so close. It's hard to like. I don't even know what the score is. I don't know who's having a good game. It's just like a whole different
Right.
experience. Our season tickets are up in Loud City, which is the upper bowl, and you can see the plays they're running. You can see all the stuff, but
Hmm.
I don't get to hear the players. So like maybe somewhere in the middle, like the club level,
Yeah.
it's
Yeah.
it's a good difference, but it's also more expensive. So maybe that's something that the wife and I, when we get to that point, we want to make sure we're
Shoot
having
for.
enough to splurge on club level seats versus the upper or lower bowl. So
Yeah.
I agree with all that. So I'm actually really curious about your answer on this next question. So Do you have any specific criteria that you use when selecting your individual holdings? I mean, I'm sure your ETF selections are the same as everybody. Like you're looking for a certain basket of funds, and then you're looking for low expense ratios and good returns and stuff like that. So that one's kind of boring. But like for your individual holdings, do you have like things like a checklist that you go through to make sure each of your positions hit?
Not a specific checklist. I want to make sure that they have a proven record. Like I'm not trying to jump into any of these newer things where they're offering high dividend yields. I don't care
You're
about
not a
that.
yield max person.
No, no, not really. I jumped into a couple. I kind of regret it now. I'm not going to jump into any more because it's like, you know what? No, I just want the company. And I'll be honest, I don't understand it as much. And so I feel like that was a stupid play for me because I was more reading what everybody was posting in the group and I was like, okay, you've done some research. I'm going to jump into this. And that was as much as I know, but that was really stupid of me to do. But no, I'm gonna keep doing what I'm doing, which is looking for kind of what you said, like what's beating the S&P 500, what are offering, which stocks are offering high dividend. I want a basket of high dividend yields, high dividend growth, or growth over a long time. So a healthy mix. And as long as I can keep it, like if I dump one off of my portfolio, then I want to replace. Like if I dump a high yield, I want to replace it with a high yield generally.
So
So
what kind of portfolio yield are you going for? Like with your current goals, like are you shooting for like a 3.5%, 4%, 1%? Like what are you going for?
probably close to a 3%. I don't, I'm not trying to be so high up.
Yeah, I mean, I think 3%'s like a little almost double. I think the S&P is always around like 1.5, 1.6, somewhere around there. So I mean,
Oh,
that's a little bit more than that. My portfolio yields like 2%, but it's
okay.
strongly being carried by like ExxonMobil and AbbVie are like two of my
Yep.
highest yielders because I also have like Apple and Visa and Starbucks, and like none of those pay high yields at all. Like I had Nvidia, which was killing my yield. That thing was at 0.06 or whatever stupid percent it was. Like basically
Yep.
your savings account interest rate was their yield. But um,
Exactly.
okay, so next question. We're getting close to finishing this up. So how important is staying diversified for you within your portfolio, and then what like rules do you use to like help you achieve that if that is something you follow?
Sure. I think having ETFs is a diversification in itself,
Mm-hmm.
just because, you know, it's an ETF. So outside of that, then I don't really care. I just want, okay, so I do feel like you've got a good strategy where you're trying to beat the S&P 500. I think most people cannot. I
Mm-hmm.
think most stocks cannot, most individuals cannot. So if I'm not trying to beat the S&P 500, then I'm trying to have something that's going to produce a higher dividend just for long term. So as far as diversification, that's about it for me. That's all I care about. Um, I think that more than that, though, I think you have to be diverse in investments in your life. So that's why I am in cryptocurrency a little bit, and I am in real estate investing and other investments. Like I'm in Masterworks. I buy fine art. Um, I buy
You don't do
precious
NFTs, do you?
metals. What?
You don't do NFTs, do you?
I don't do NFTs. No, I don't.
That
I don't care anything about
yeah.
NFTs. Although I think NFT art is something that blew up, and it's not like NFTs. We could get a whole different thing. Like what it should be used for is not really even art. It should be used to solve a problem, like having your property deeds in an ETF so people can't still steal your property, which is a huge scam and it's very prevalent. And I think a lot of people don't realize that. So the security of an NFT on the blockchain, I love that part of it, but I don't care about any NFT art. But like other things, like like I said, like fine art, precious metals. Like I think you should have, and cash. I mean, so many people say I don't want any cash, and I think that I'll Ed Milet said this, and I love listening to him as far as mindset. But he was talking about cash is king. Cash is always going to be king. It's not going to make you money like your dividends will in the bank. And I don't advocate for somebody even having a huge, strong savings presence, honestly, because I think that you're not earning your full potential. But I think that having some cash, I mean, you walk around happier if you know you have some sort of fallback. Now, if you're in stocks or whatever, you can always sell them and that's good. But then you have to sell something that you've worked really hard for. So if you have, I think you just walk a little taller. Like if you can say, hey, I can go into this restaurant and I know that I can splurge on the drink that
Yeah.
I want. Your example earlier for Coke or Pepsi or whatever it is, um, because I have a little bit of cash in the bank, then I think you feel more secure in life. And I think that whether no matter what you're trying to do, like I'm trying to be an entrepreneur on the side. So if you have a little cash in the bank, you can negotiate better. You can negotiate better for what you want. You can say, I am someone who looks good on paper. Like I can get a loan for something I want. So I think diversification in general is smart across all investing. And also I still think there's a reason to have cash. It may fail, but there's a reason to hold it just for all the reasons I mentioned.
Yeah.
So.
Yeah. I agree with that. And it's not even the, like you said, whether it's holding cash, literally or figuratively, it's more like, so I can relate to what you said about like being able to go to the store or like the store, or the restaurant or whatever and buy whatever. So when I was growing up, I was in one of those situations where it was like, hey, we have, $62.50 to take to the grocery store. We get up there and we're at the thing, they're scanning, and then, hey, we can't get everything from here back because we don't have enough money for that. So like I got to see that a lot growing up. And like I made like a commitment to myself that like there might be times when I go to the grocery store, I'm like, yikes, I spent $92. I was hoping to spend 50. Like that sucks. Like next week I'm going to get tuna instead of, ground beef or something just to like help even it out. But like I told the wife, I was like, it's kind of cool that when I was growing up, we'd go to Walmart to get our groceries. And we went from like, there were things on the little conveyor belt that we weren't able to get. And now I don't know that there's anything in Walmart that I couldn't buy if I wanted to. I don't buy everything I see in Walmart, but like if there's like, I don't even know what the most expensive thing in Walmart is, but like whether it's a TV or a furniture or whatever you could get at Walmart, like there's not anything that Walmart sells in the store that I couldn't like swipe my debit card and get if I wanted to. And like, that's what you say going about like the confidence, like it's not even the confidence that like I can get this and you can't or something like that. It's more like the confidence of like, I've worked hard to get here. And I also like having confidence just it not even gives you other opportunities, but it gives you the mindset to absorb other opportunities better than somebody with no confidence. Because like I do the same thing with the gym. Like I'm a power lifter. So like the confidence that I get, like I might not be the best looking dude at the gym. I think I'm top, 20%, but like I'm not, I have the ability to like, when I go over to like the power section, they call it the strong section at my gym. When I go over there, I have a different kind of confidence because whether there's a guy that's been lifting for 30 years and he's way bigger than me, or this, some young kid that thinks he's the next big thing on the block or whatever, I know that like I have confidence knowing that I'm one of the strongest guys, if not the strongest guy in the gym. So like, it's just different. And like, if somebody, I carry myself that way, not in like a cocky way, but like in a confident way. So if somebody, whether it's a new person, an old person, whoever it is, they ask me a question, like I can answer the question with confidence. I can step away from what I'm doing because I know what I'm doing. I know how much time it takes me to do whatever I'm doing, and I can help this person. It might go in one ear and out the other. Who cares? But like at the end of the day, my job isn't to make sure that they apply the information. My job is to provide the information. Same thing with the YouTube channel and these interviews. Like my goal is to have everybody apply the information that we're giving them, whether it's, good or bad, whether something that you said that you like, maybe something I said, they can guarantee that that's not for them. Great. I did something. Like I helped you understand what is or isn't for you. Like that's good. Mm-hmm. At the end of the day, I can't make anybody apply any of this information. So it's just for entertainment purposes. If you can take something out of it, that's the goal. Because like if you lost money selling Tesla and you identified why you lost money selling Tesla, maybe somebody else can identify that and they don't make the same mistake you did and you save them money or you make them extra money because they're not going to do the same thing you did. So like that's the point behind this series. And more of why I wanted to ask the questions that I'm asking isn't because like there's anything specific to you. There's things that specific to investors that everybody can take something from. So I don't know if that was like more of like a self promotion, but I think all
Yeah,
that makes sense of
no,
like ties into what we do and why we do it.
it does make sense. I love what you said. You echoed a lot of what I feel just in the confidence arena. I think that if you need something so badly, you're going to lose. You're
Mhm.
going to lose no matter what.
Well,
You're
you're in
going
a
to lose
bad
the stock
position of like
market.
negotiation and all kinds of stuff. Like when you're at the point where you need to sell
Yeah,
your stocks or you need to like
exactly.
how do you think companies like errands and payday loans and stuff like that exist? Like some people are
Exactly.
uneducated and they don't know the scheme behind that stuff, but some people are just in a position where they quote unquote need something. Most of the time they end up borrowing money at enormous interest rates for things they don't need, which is even worse. But like when you go to errands, you're like, I need a big screen TV because the sports are coming on or whatever. But like
Right.
you're gonna go there and you're gonna spend $13,000 on a big screen TV that you could have bought for $1,000, but because you are bad with money and you didn't manage your money to save $1,000, now you're gonna spend 13,000 on that TV over the
Mhm.
course of the next 3 years, paying an easy, $100 a month for the next whatever, but whatever that math comes out to. But like that's the confidence and the knowledge and like the power it gives you to be confident and have stuff like that is where you can, if somebody's going to screw you over, you can be like, I don't need this right now. And same thing with you with the deals. Like if there's a deal that if you were in the position where you needed money, you might be more apt to take more risk because you have to have that money. But because you're in the position you're in, you can back off of a deal and say, I'm not interested at this time because I don't need to do this deal.
That's what I'm talking about, even with stocks. I
Mm-hmm.
mean, if you have not been an investor, and I know we talk about timeline, I think that younger people, I love talking to younger people because I think they have something that no one else has, which is time. Now, we're all not guaranteed, the end of our lives, but they're time rich. So they're time rich in any investment. They're time rich in the market. If you have not saved and not invested, and you don't have a Roth or whatever it is, and you go approach it in your 50s or 60s, I mean, you're going to be you're going to be trying to make moves to secure your future, and you can do it, but you're approaching it from a risky, needy position, and it changes the psychology of what you're doing. So I think that if you can just be consistent and level headed, and you can consistently grow every single portfolio that you have, no matter what it is, if one falls, your confidence is still up and all the rest, and you're not going to go on some selling spree
Mm-hmm.
and sell everything out and get all my money and put it under the mattress. Like, you're not going to do all that stuff. You're going to be like, I failed over here, but I have all these other things. And that could just be your dividend portfolio where you failed in one stock, but you have all these others that are performing well, and so you don't care so much. Or it could just be in life in general. I have cash, I have dividends, I have this investment, that investment, I have a house, I have these things. If I lose my job here, I have grown, enough to where I can fall back. Hopefully, I'll find another job, but I'm not left in a position where I can't provide for my family, or I can't, you know what I mean? And
Mm-hmm.
I think you walk differently and act differently and you live differently and you live a happier lifestyle. And that does mean, I mean, it doesn't come easy. It does mean you have to be disciplined at the beginning, or now, or wherever you are. You have to start having some sort of a habit and discipline of, I've got to be manage this better, so that you can, and it doesn't take as long as people think. Like, you can grow a small savings, you can grow a small dividend portfolio, you can grow this if you apply whatever amount of money you have, whether it's nothing to, just $5 here up to thousands. Like, you can grow something that can get you in a better position than you are now.
Mm-hmm.
There's no excuse for it. There's so much abundance in this country. If you want to make money and you want to have an investment and you want to live a happy life, you can do it. It doesn't matter if you are, I don't judge anybody's job. Whether it's, if you have a job, I love it. Like, if you are a hard worker and can apply simple principles, you're golden. You can
Mm-hmm.
do it. Anybody can do it.
Yeah. Yeah. I think that's a really good message and important message for people to actually like understand is like, I know some people that have like, I call it like the victim mindset where it's just like, bad luck happen. Like the wife and I have bad luck literally all the time, but like that we don't, obviously we'll talk about it, complain about it or whatever. I think that's only natural, but like we keep it moving otherwise, and we still do other things. We try to make educated decisions based off of some of the bad stuff that's happened to us to like mitigate some of that risk. Like, for example, we tried to, I don't know, do you know what a Murphy bed is?
Yes.
Yeah. So we bought one of those, and we bought like the tall one that looks like a bookshelf kind of thing.
Okay.
And we bought it for the guest room. And we bought, I think it was from Wayfair. We just, a reputable company. We knew what we wanted. We searched around for a while. We found it. We ordered it. We get it. And they sent us 2 different boxes. Like it came in 3 boxes, but one of them was like for a brown Murphy bed, and one of them was for the white Murphy bed that we got. And I was just like, what are the, one, what are the odds of that? 2, we waited like a long time. We had to have the Murphy bed by a certain time because we had like guests coming over and stuff. So we were going to put it together and all kinds of stuff like that. But like it was that complicated thing. And then we were like, okay, like we called them, they fixed it. They sent us the right one. But I was like, what do I do with this box of wood that I can't use? Like, what do I do with this? So like, it's one of those things where it's always bad. But like all that to say, like the victim mindset is some people have that and they think, woe is me, the world's out to get me. Like, no offense, but the world doesn't know you. The world doesn't know whether you are here or aren't here. Like the globe's going to keep spinning every day. It's not flat. I don't know if that's news for anybody, but like it's going to keep spinning. So it's like one of those things of like realizing that you're not the victim. Nobody cares, as bad as this is to say, nobody cares about you individually. Like as the whole, the world doesn't care about you individually. And it's just up to you whether you make the good out of bad situations and make great out of good situations. So I think that's really important to take away.
Yeah.
Yeah. Okay. So 2 questions. Last one. This one probably will go quick. So do you have any dividend or investing related myths or misconceptions that you hear all the time? I mean, we kind of just spoke on one, like thinking that you can't do it, whether it's little bits of money or anything like that. But do you have any like myths or misconceptions that you hear all the time that you're just like, that's like quite frankly not true, and here's the truth on it?
No.
Yeah, the one I always hear is like dividend investing is like an old person's game. I hear that all the time, and I'm like, actually, like the sooner you start it, the better it is. Like
exactly.
Like you don't like compounding is a magical thing, and if you have 10 years to let it compound or 45 years to let it compound, there's a big difference there. So okay,
yep,
okay. So last question for you then. So somebody watching today's video, you've done a great job. You've convinced them to not only invest and broaden their investments to have a bunch of different diversification. So they're going to do that, and they're going to specifically decide to dividend invest in the beginning. So they're going to broaden their investment horizon, but they're going to dividend invest, and they are going to invest. They've never invested before. So like, what would be your tips other than just get started of what this person should do, or like things that would help them be successful?
Yeah, my tips I would say pick 5. Start there. Don't go more than 5. Maybe make 2 or 3 of them ETFs with returns. So look at a high yield or a high growth. Do some research there, and then pick 1 or 2 individual stocks that you like, that you've researched, that you've heard about, that's an aristocrat or a king, like something that's
things you use, like you go to Costco all the time, or
yes.
Microsoft or Apple, or
exactly. And then see how that feels and consistently invest. Like I invest weekly. I know you said you invest daily. Just consistently invest it over a period of time and start there, and don't try to go above that. Don't try to, start buying 10 or 20, or just stick with those. And then learn more and see where you want to go from there. Watch Troy's channel.
There you go.
And he'll steer you in the right path. But don't try to do too much is what I'm trying to say. Like I say start safe, but even that's not even starting safe. That's starting in a great place.
Yeah.
You know what I mean? Like your diversification is a key, and also small and manageable, so that you can track it.
I think the better way of saying that is just like it's starting based off of your knowledge level. If you don't know a lot, there's no, like, you don't want to spread your lack of knowledge through 40 stocks if you don't know anything about any of them. Like at least start with, and like I have heard that advice many times, especially with the ETFs. Like my tip for somebody would be like VOO or VTI or even SCHD, something like that. Like get into those. And if you never gain an interest in it, constantly just invest in those, and that you're good. Like you're good forever. Just if you're always putting some amount of money into those on a somewhat frequent basis for long periods of time, you'll be okay. And then if you do gain an interest, that's where you can do your Microsofts, your Apples, your Visas, your whatever things you use because like you're like at VOO pays a dividend. So like you're getting a
Yeah.
dividend from VOO. You're like,
I
what's a
love
dividend?
VOO.
Yeah. So then you just start like falling down the rabbit hole and you start learning what this is. Like, oh, what companies make up VOO? Like maybe I can start building my own thing. Like, I don't like Altria because, maybe you consider that to be a sin stock. So you want to do VOO, but you don't want to do Altria. So maybe you start buying some of the stocks that are in VOO that you do like and not the ones that you don't like. So you could just, change it around all kinds of ways. So I do like that. I like the idea of, I think it's Warren Buffett that says like, pretend you have like a punch card in life and you have like 10 slots. And every time you pick a stock, you knock off one of those stocks. And it really makes you think like, hey, I don't have a lot of different things I can spend my money in. So I need to really understand what I'm buying and why I'm buying it. Cause like, is this worth 10% of the stocks you could ever buy? I mean, obviously you can buy however you want, but if you think about it like that, then you're going to make wiser decisions than just, $1 over here, $2 over here, whatever. So, but yeah, I agree with that. So
you can also grow those positions. You can
yeah,
make larger positions by doing that and then take some of those dividends and
yep,
play with it somewhere else if you want to do that.
yep,
So if you start small, then you grow a larger position back rather than having tiny little positions in a lot
yeah.
of things.
I did that same exact, when I first started, it was 36 holdings, 3 ETFs. And it was cool. I was getting paid, frequently. And I picked all these stocks for certain reasons and stuff like that. But it was, I had like, there was probably 2 or 3 stocks that I had like a whole share in. And like everything else was like, I had Sherwin-Williams before they did a split and I had like 0.008 of a share of Sherwin-Williams. And I was like, okay, like what am I doing with this? So,
Exactly.
and not like to say that, also to say this is like everybody starts somewhere. So you're going to have 0.008 of a share, or when you get your dividend and you reinvest it, you're going to get 0.01 of a share coming back. Like it all starts like that. And that's why I post like my monthly recaps to show you like, hey, I've been doing this for a while. I'm not chasing yield. I don't really care about my dividend income right now. I'm just trying to build a solid portfolio. And here, like I got, $16 from whoever it might be. And here's how much that got me, which somebody might not care about $16. They might not care about the 0.3 shares that I just got from that. But like when it's like the life cycle of a dividend investor, when you make your first dollar, nobody cares. $5, nobody cares. $20, nobody cares. But when you start getting into $100, $1,000 a month, $5,000 a month, they're just like, what are you doing now? I'm like, the same thing I was doing when I was getting 10 cents.
Exactly.
It's just got time. So anyway, Amber, thank you so much for taking time to speak with me today. It's been a pleasure. I hope you enjoyed your time on here.
Sure.
And
Absolutely.
if you have, I think you said you don't have anything to plug, but you have some stuff that we will talk about. If there's comments on anything that Amber mentioned in during this interview, leave those down below in the comments, and we might have her back on to explain some of that stuff. So Amber, it's been a blast, and we'll talk to you next time.
Absolutely. Thank you so much.
And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time, see you.